And we think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life. In the battery space, battery pack systems for every cumulative doubling, and we're in very early days of electric vehicles, so we're going to see many cumulative doublings. Those costs drop 28%. So think about that. In the transportation sector, deflation driving a boom in electric vehicles. We're seeing the same in industrial robots. I think it's roughly 25% there. We're seeing artificial intelligence training costs drop anywhere from 37% to 50% per year. So, and artificial intelligence is going to permeate every sector, every industry, every company. And those companies not embracing it the way they should are going to lose out competitively. So we're very excited about that source of deflation because it will cause a boom. So that's a deflationary boom. The ramifications of this good deflation are going to include creative destruction, disintermediation or disruption of the traditional world order. And we think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%. And what does this mean? What we think is going to happen here for those companies who spent the last 20 years catering to short-term investors who wanted their profits and wanted them now. Companies were leveraging up to buy back shares, pay dividends, and they were not investing enough in innovation. In fact, many didn't take seriously the idea that innovation was a threat. I know when we started ARC in 2014, auto manufacturers, auto analysts thought, this was something for the mid-20s, maybe. And we were looking at the cost declines in battery pack systems, and we were saying, nope, this is happening now. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life. So we're going to see a lot of that in financial services, energy. So the two sectors that have done best this year, we believe, are two of the most vulnerable sectors. In the energy space, again, up 40% year to date. We think that electric vehicles, and especially autonomous electric vehicles as they launch within the next few years, are going to put a big dent in oil demand. So that's the bad deflation. Those companies that are too leveraged and have products that will be obsolete are going to have to sell those products at a discount increasingly in order to service their debt. So good deflation on one side associated with an innovation, and bad deflation associated with the creative destruction caused by innovation. The third source of deflation that we believe will take place maybe toward the end of this year, probably more likely next year, is commodity deflation. We believe that there is a lot of double and triple ordering taking place right now.
Every investor lives with the risk, no matter how remote, of a major economic meltdown. It has happened before and it will happen again. And if it does, years of hard-earned savings and retirement funds could be wiped out in a matter of a few hours. Now that one statement alone can scare a lot of investors and might question them, should I invest in the market at all? Like, should I be involved with the risk and all the stress that comes with it? And fortunately, there are steps you can take to shield the bulk of your assets from a market crash or even a global economic depression. Preparation and diversification are the key elements of a sound defensive strategy. Together, they can help you weather a financial hurricane. Well, when it comes to market crashes or correction, diversifying your portfolio is probably the single most important measure that you can take to shield your investment from a severe bear market. And depending on your age and your risk tolerance, it may be reasonable for you to have most of your retirement savings in individual stocks and mutual funds or exchange traded funds. But you need to be prepared to move at least a good portion of that money into something safer if you see a crisis looming. Individuals can put their money in a wide range of investments, each with its own risk: stocks, bonds, real estates, cash value life insurance. You can even put a small portion of your holdings into a small interest in the producing oil and gas projects. Spreading your wealth across several of these categories is one of the best ways to ensure that you have something left if the bottom does fall out. Whenever there is a real market turbulence, most professional traders move to cash or cash equivalents. You may want to do the same if you can do it before the crash comes. And if you get out quickly, you can get back in when prices are much lower. And then when the trend eventually reverses, you can profit that much more from the appreciation. And when it comes to professional investors like Warren Buffett, pretty much everything Warren Buffett has been doing recently indicates that he is relatively bearish. Buffett has been a net seller of stocks for 8 consecutive quarters. Berkshire Hathaway should disclose its portfolio transactions for Q4 in a couple of days, and I expect Berkshire's regulatory filing will reveal that Buffett's net selling streak extends to 9 quarters.
And companies never quite know if it is double or triple or ordering. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. But we do think that inventories will build to a level well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices. In terms of the recent behavior of value stocks, especially those that we believe are in harm's way, compared to the severe drawdown of innovation-oriented stocks, I like that setup very, very much. And just to finish on that note, we have a 5-year time horizon, as do most focused on long-term innovation. And in the middle of February, those strategies generally, according to our analysis, suggested that innovation would reward investors, again, if the analysis, top-down, bottom-up, of the possibilities associated with innovation are correct, would deliver a 15% compound annual rate of return over the next 5 years. Well, nothing has changed. Nothing has changed except the stock prices have come down. We're in bargain basement territory if our view on innovation is correct, the 5 innovation platforms. So if the return expected at the beginning of all of this was 15%, then the return expected now, again broadly, should be in the 25 to 30% range.
Another sign of Warren Buffett's less than rosy outlook is Berkshire's cash pile. As of September 30th, 2024, the conglomerate had cash and cash equivalents of $325 billion. That's huge. So should not overlook the valuation metric bearing Buffett's name. The Buffett indicator measures the ratio of total US stock market capitalization to GDP. And Warren Buffett, the legendary investor that he is, avoids making stock market predictions at all. In 1992, Warren Buffett wrote one letter: "We've long felt that the only value of stock forecasters is to make fortune tellers look good. And even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place away from children and also from grown-ups who behave in the market like children." In a 2008 shareholder letter, neither Charlie, my partner in running Berkshire, nor I can predict the winning and losing years in advance. In our usual opinion, we don't think anyone else can either. And the same view came up in Buffett's 2022 letter to Berkshire shareholders as well. When the stock market plunged in October 2008, Warren Buffett said that, let me be clear on one point, I can't predict the short-term movements of the stock market. I haven't got the faintest idea as to whether stocks will be higher or lower a month or a year from now. But Warren Buffett added something that every investor should consider. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. Warren Buffett would not try to forecast a stock market downturn. However, he knows that if one occurs, it will present a buying opportunity, and he wants to be ready if and when such opportunity arises. And having a pile of 325 billion of cash in your hand, well, that comes in handy when an opportunity comes around. And he's only buying high conviction stocks that meet his investing criteria. He has amassed a hefty cash stockpile that could be used to aggressively buy stocks if a market downturn makes valuations more attractive. Warren Buffett's words and actions underscore an important lesson for all investors, that preparation beats prediction. And the IBM traded at an average of 59 times forward earnings, adjusting for the relative sizes. And today, the 5 largest AI stocks, Microsoft, Nvidia, Alphabet, Amazon and Meta platforms, trade at an average of 49 times forward earnings.